Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, January 9th, 2026. We're recording at 4 p.m. Eastern Standard Time. I am your host, Scott Slayton, partner and chief strategist at Capital Creek. Now, here is your starting lineup. Number 1, the changing world order, the Don Rowe Doctrine, comes into full focus. Number 2, December non-farm payrolls are weaker than expected. And number 3, market impressions from week 1 of trading in 2026. We'll start with number 1 at the top. The new year started with a bang, literally, when Maduro was captured in his own palace in Venezuela. The U.S. administration is changing the game in the Western Hemisphere. A new muscular and interventionist foreign policy was on full display early in 2026. But it seems to have had modest near-term impact on equities, oil markets, and even volatility. March Brent crude oil prices are up a little bit to start the year in the wake of all this. Brent curves are flat all the way out to June of 2027. Basically the same price out in June of 27 as we see today. Venezuelan production has fallen from over 3 million barrels produced per day 15 years ago to around 800,000 barrels of production today. My friend and famed oil analyst Doug Terreson believes that Venezuelan production could be up about 500,000 barrels a day 1 year out. But the glutted oil markets do not need more production. And while CEOs are visiting the White House to listen to calls for greater production and investment in Venezuela, we think they will politely decline because there's too much uncertainty in that market. That is expensive oil that doesn't make sense at current prices today, and we think it's going to be harder than expected to get them to invest in Venezuela to increase production of that very heavy sour oil in the Orinoco Belt. Interestingly, the MSCI Latin American Equity Index is up 3.5% year to date, one of the best performing regions of the world. That marks a 5-year high. So imagine this, a major leader captured, taken to New York in the middle of Latin America, and Latin American equities are hitting 5-year highs. That tells me this must be a bullish development. I wonder, will Russia and China have a material response in the near term? After all, they have significant investments in Latin America. Should equity risk premiums be rising on this new world order, or a return to the Monroe Doctrine? Well, certainly not yet. If anything, equity risk premiums are contracting. Is the Maduro event here the first domino? What happens to Cuba? Is Greenland now in play? One would think political risk premiums would be rising, but that does not appear to be the case. And to me, that's bullish. Number 2, December NFPs. They were weaker than expected. The U.S. economy added 50,000 jobs in December versus 70,000 estimated by economists. The unemployment rate fell modestly from 4.5% to 4.4%. But the U.S. labor market continued to soften into year-end. That's the bottom line from this report. The 2-month revisions were minus 76,000, and I thought the most interesting thing in the whole report was that the 3-month average change of non-farm payrolls was minus 22,000. So net job losses on average over the last 3 months. That's kind of a big deal. Average hourly earnings up modestly, but not a big problem because productivity continues to be very strong and consistently strong. Weekly hours at 34.2, right in line, very stable all year, not a lot of movement there. The U7, or the underemployment rate, fell from 8.7% to 8.4%. That's a pretty big drop. But those underemployment rates are up significantly from the lows of 6.6% in June of 2022. So the U.S. economy appears to be booming. Atlanta Fed GDP now is running at a stunning 5.13% for the fourth quarter. But labor is not participating fully in the boom. The public is not feeling the boom. And you see this in the consumer surveys, which consumer confidence is near historic lows. And we see this in some of the political polling, that the public is frustrated. They're not feeling the boom. So profits are rising briskly, margins are near all-time highs, and productivity is strong, but labor is weak. Interesting dichotomy there. I don't think these data for these December NFPs move the needle for the Fed in January, but if the trend continues, the March, April, and June meetings could be very much in play. And remember, we'll have a new chair in May of this year, as Powell is on the way out. So we expect 2 or 3 additional rate cuts in 2026, and we believe we will end the year at 3% on the federal funds rate. But there's a long way to go between now and the end of this year. Number 3, market impressions from the first week of trading. The S&P 500 continues to lag the rest of the world. It's up only 1.86% year to date versus almost 2.5% for the All-Country World Index, ex the USA. EM equities are especially strong to start the year, up almost 3% year to date. And the Korean Kospi, one of the world's most cyclical markets, is up 8.8% year to date. That is staggering. In 1 week, the Kospi has performed more than it usually returns for an entire year. We mentioned Latin America, MSCI Latin America up 3.5% at a fresh 5-year high, and really no volatility at all on the Maduro capture. That is a beautiful chart, just slowly moving from the lower left to the upper right. Metals remain red hot. Silver, which had a parabolic move to end the year, and then a significant correction, is up 12% year to date. Platinum is also up 12% year to date. Gold up a very solid 4% year to date. And oil, the most hated and shorted market of all, is up 3.6% year to date. The Oil Service Index, OIH, up 11%. One of the more interesting trends I'm seeing early this year is that the Russell 2000 Small Cap Index is vastly outperforming the S&P 500. The Russell 2 is up almost 6% year to date. The S&P 400 Mid Cap Index up almost 5% year to date. Meanwhile, the Bloomberg Mag 7 Index is up only 50 basis points, a major laggard. Cyclicals just appear to be outperforming across the board in a booming economy. Value's doing better to start the year. So the stock market is broadening out, much as the bulls had hoped for the last couple of years. And tech is lagging, except for the semiconductors, a very cyclical group which is doing well this year. So these big hyperscalers are being held back, in my opinion, by way too much CapEx spending, which ultimately leads to declining returns on invested capital and lagging stock prices. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.